Good morning, good afternoon, or good evening, depending where you are on the planet, and welcome to the Thursday, the 22nd of May, Bull versus Bear webinar. Steve Miley here on the Call for Trade Day. Welcome to all the Trade Day team. Welcome, everyone. We're going to go through our usual regular run through in here today. We're going to take a look at the calendar, what we've had, what we've got coming up. We'll take a look at some articles from the major news wires. What are the fundamental geopolitical, macroeconomic data, central bank, geopolitical driven risks and events that are shaping financial markets right here, right now. And then we'll also take a look at some charts, what's going on, where are the potential trigger points going into today. Let's start with the data. I'm going to actually start with today rather than looking back. We'll look back in a second. But we've had some data already in here this morning. You can see today is the global PMI data. So you can see all the data for Europe in here. And as you can see in here, a mix of red and green, more red, if we're quite honest in here, compared to green in here. So we've had this is not the US ISM PMI data we're getting through here. And that's not what we've got coming up from the US this afternoon. So this is the preliminary, what we call the flash. You see the little P's, all these little P's, right? This is the preliminary data, the flash PMI data, flash being early. Okay, so this, as you can see, this is the data for May. We're still in May. We're on the 22nd of May. So this always comes around the 20-something of May. We get this data. And what they do is they take 80. This is remember the PMI data, Purchase and Managed Index, is a survey. Okay, so that when they have 80% of respondents, about 80% of respondents in from the global surveys, they publish the data. So it's kind of a preliminary data. And to be quite frank, these numbers are not very different. They don't end up being very different because you only get another 20% of responses after this date. So they're at least 80% of responders are in by now. So this data is pretty much how it ends up when they publish it around the very beginning of the month. That would be next month for May, in the beginning of June. And then we do get, obviously, later on at the beginning of June, also on the same day when we get this final data, we get the ISM, Institute of Supply Manager, which is like kind of the more official, longer dated data stream in here. But this data is very useful when we obviously get it early. And you can see in here, so far from Europe this morning, it's been a real mixed bag. French data in here, better on the manufacturing, worse on the PMI. German data in line on manufacturing, worse on services. And then we go to the Eurozone, worse on both manufacturing, services and composite. UK in here, better on the composite, and the services worse on manufacturing. So really mixed in here across the board. And so all focus now going into today is going to be on the main, this is the main data point we have really for the week in here. So we get the S&P Global Services Manufacturing Composite data for the US. That's at 9:45 Eastern. So we're going to keep an eye on that today. Also get a little later on today, but he has been speaking already this week. Fed's Williams is speaking at 2:00 Eastern also. So I think the real main focus on here, though, is the PMI data at 9:45 today. Let's turn our attention to the macro, what we've had and what we've got coming up as well, and what's in the morning briefing Americas from Bloomberg. Well, CEO Jamie Dimon are pointing out that we're at stagflation risk in the US. What is stagflation? It's a combination of the stag is for stagnation, so that's going into recession, and the inflation is inflation. It doesn't happen very often, but there's potential that we've still got inflationary pressures. There's potential those inflationary pressures going higher because of potentially because of tariffs, and then also to go into recession as we see a potential global slowdown and US slowdown, again potentially driven by the tariffs in here. So threat of stagflation, and Jamie Dimon pointing that out in here more recently. House Republican leaders released a new version of Donald Trump's massive tax and spending bill with a higher limit on deductions for state and local taxes. The main problem here is in here, this bill that's going through and making its way through could be an issue for increasing debt. And the big driver of yesterday's sell-off was concerns around the debt burden in the US and concerns that the Treasury bond auction from yesterday didn't go particularly well. So We saw a 20-year auction yesterday, 20-year bond auction. It went worse than expected, which meant bidders came in lower than expected. So the bidding price was lower. So lower price than expected equals higher yield. So yields went higher. And remember, yields going higher is a negative for stocks. It's longer term interest rate. It's a negative for the consumer, right? Longer term interest rates, potential longer term remortgage rates. Okay. So that pushed to lower prices because of a poor debt auction, triggered the move to then lower prices. Lower prices right the way across the treasury curve equals higher yields, and higher yields then negative for stocks. So the sell-off that we saw yesterday was linked to that bond market move lower, to lower prices, higher yields. And we've seen that following through today. And then obviously there are concerns that the bill that's going through, the tax and spending bill, which is going to push potentially push the bond market is pushing back on the president's tax cut plan, and that's what we're seeing in here right now. I'm going to open that one up. I think I've already got this one open in here. So look, bond market warns Trump Congress of dangers of swelling the deficit. So that's what the bond market was signaling yesterday. And there it is there. Yeah, I've already got it opened up here. So look, market test investors' nerves as stocks sell off after auction. It was the auction that triggered it. Initially, the auction, the bond market telling us they're not happy in here at the moment. They're not happy about how the economy is going. They're not happy about potentially this spending bill. So the bond market reacts, and then the stock market has reacted to that as well. Look, it's the same one, right? Bond market. No. So this one here. I think I've opened this a couple of times. Yeah, bond market warns Trump Congress of danger of swelling deficit. Yeah. Stock bonds steady as tax bill gets House nod. So overnight, though, so that was the tail of the tape from yesterday. Overnight, market's a little bit calmer in here and wait and see mode. Now we're all eyes on how the bond market continues to react, and then obviously how we're going to react when we get this data out today at 9:45. Is this data going to show a slowing? Are purchasing managers getting more concerned? I probably mentioned to you guys before, when I was at Credit Suisse many years ago, we had one of the best strategist economists in the world at the time, Jonathan Wilmot, and at Credit Suisse they devised a whole set of leading indicators called the risk appetite leading indicators, and they were much sought after by the hedge fund community. These indicators, and they were based on the PMI, the global PMI data. It was seen as a very good lead indicator of how the economy is going to be reacting in 2 to 3 months' time. So PMI is always a much-watched set of data. So if we go and look in the overnights in here, what we've had is stocks lower in Asia, over 0.8 and 1.2% on Nikkei and Hang Seng respectively. Similarly, European stock averages, the European exchanges following the US sell-off down yesterday. So the UK FTSE down 0.7, just over 0.8 on the German DAX, and nearly 1% on the French CAC. And if we look on the overnights, though, markets kind of had a slight rebound here on the Nasdaq, up 0.3, but the S&P 500 treading water overnight, having suffered those losses yesterday. Little to really add on the Fed watch tool in here. Yeah, pretty much no chance in here for a rate cut in June, and very little chance of either a rate cut in July. Markets pricing in really the first rate cut to come with, 68% chance of a rate cut then by September. So, and that's what the Fed speakers are kind of indicating to us as well over the last week or two. And then by the year end, maybe 2 rate cuts by year end in here is what the market's pricing in. This is what drove markets, the stock indices lower in here, was this spike higher. So we can see here on the 10-year yields, we spiked higher yesterday and going higher again today, moving above this spike. Remember, this was when the market was really concerned about both the US economy and potentially a failing of the bond market. So there was real concerns after the initial move lower after Liberation Day tariffs. The market really reacted, the bond market reacted to move to higher yields. And that's when, after this big move to higher yields, that's when Trump hit pause, because they realized that this was going to cause real problems. The bond market's going to higher yields. Well, we're actually now at higher yields than we were back then in here. Actually, when was the dating on this? This was beginning of April, right? Yeah, because the tariffs went on right at the beginning of April, right? And then we initially went to lower yields and then spiked back up to higher yields. And we're at higher yields now, and the yields tracking a little bit higher. So that's certainly a negative going into today. And we're seeing here, if we go to the 30-year, we went back towards lower yields in here yesterday, but the 10-year was the one, lower prices, higher yields. So lower prices equals higher yields, significantly lower here. And in 5-year note, that's right on this longer term trend line, and 2-year note also edging lower. So all of this is lower prices, higher yields, and negative for stocks, particularly negative for growth stocks, particularly negative, therefore, for the NASDAQ. And then if we go and take a look on the stock indices, although we're still hanging on to our upside bias in here, the sell-off that we saw yesterday is a little bit of a concern, particularly here. You can see the S&P 500 playing with this trend line in here that goes up to the bit from the lows that we posted in back in April. Right? It's playing with this trend line. If I go to the live chart now, you'll see it here. We've got dual trend lines, actually. So we've reversed this more accelerated trend line that comes up from, where are we here? This is from the 7th of May. So this more accelerated trend line, we went through that yesterday. We broke down through that. And you can see at the moment, the market's flirting with these two trend lines. The one that comes from the very low that we posted all the way back here, in here at the early part of April. So after we had the sell-off in here, after the Liberation Day tariffs in here, that's the low there. So this trend line in here that comes up through that low, that's the one we have on the chart here, that trend line there. So we're flirting. You can see we were breaking that even yesterday and flirting with it in here. So this is the one that comes all the way up here. This is the one we're flirting with at the moment. We're just sort of nudging below. So this is an important trend line. But you've also got this inside, I like to call this an inside trend line. This one's really strong. You see 2 points here. We went down to it here, moved away, went down to it here, moved away. And now we're back, went down to it yesterday and then held. And we're right on that trend line. So we're flirting with these two trend lines. The trend lines that come up from the 9th of April, that one through the low on the 21st of April, and this one in here off the low from the 24th of April and the 30th of April. So these two trend lines in the market's flirting with them at the moment. I think there's a real risk if we break down further, we could get acceleration lower. So we're watching those supports. Similar story with the NASDAQ. We've broken down through the more accelerated trend line that comes here from early May. We're still above both the trend lines in here. And you can see that on our analysis, going back to the charts. And if we go to the NASDAQ, we're way above that trend line, but we're getting closer on this shallow, this inside trend line, again, coming through from the 24th and 30th of April. Off those lows, you can see the market bounce almost exactly off of that, went down close to it here, moved away. And we're not quite down there yet. But if we move down towards, I'm going to say around, where are we in here? If it gets down towards 21.30 today, maybe 21.30, 21.50 kind of area. That's going to be worrisome if the NASDAQ starts breaking down for that. So watching out for those levels on the downside today. Whilst above that, I'm clinging on to a positive bias and looking for a rebound. Because at the end of the day, this market's kind of really more sideways than anything else, right? But, S&P looks a little bit more fragile with the sell-off that we saw. So just watching out in here for those support levels. We start breaking out to support. It looks bearish. I wouldn't be surprised if we get a rebound today. But I think the real trigger point is going to be this PMI data that we get coming up at 9:45 today. So 9:45 Eastern. Keep your eyes on that going into today. Guys, I'm going to wrap it up there. I'm out. I'm on vacation in here, but Duncan is covering from tomorrow through to the beginning of June. So Duncan covering tomorrow through the beginning of June. Remember, it's the holiday at the weekend. So US stock markets closed in here. We sent an email out already on that. So watch out for that. Market's going to be closed. We're going to close down the markets in here for Memorial Day on Monday. And then UK markets are actually closed as well. So it's going to be a very, very, I would suggest not trading on the out of hours sessions in here. Markets are going to be kind of probably tricky and illiquid. And I say I'll be out until the beginning of June. Going to wish you all a great trading day today. It's going to be Duncan's capable hands through till then. And take care and stay safe. Thanks, guys. Bye.